probably two primary factors that has the market reconsidering the inflation outlook, particularly for the US. One is, of course, Trump's threat of tariffs, which he sees as a negotiating tactic to give him greater leverage when he negotiates with other nations around trade flows. And the other is, of course, that he's very likely to extend the tax cuts that were a key element of his previous term. And he's talking about new tax cuts to go with it. So they are obviously inflationary pressures that the market has clearly understood and really is pushing against what was actually somewhat of a disinflationary dynamic coming into his election, in that if you look at commodity prices, energy prices and the general trend within inflation, there was definitely a deceleration of inflation, albeit with a very recent blip upwards in the most recent print.
Got it. The US economy by itself has not done too badly as well, Shaun. I mean, the results itself plus the other data points coming in. Would you reckon, therefore, that forget rate cuts, but there could be rate hikes as well come 2025? And what does that do to this general belief that existed that with a rate cut trajectory will come flows from US into the emerging market pack, and there will be dollar weakness, etc. Does all of this get thwarted?
Well, certainly there's a recalibration in market expectations that's absolutely appropriate. So what you can see is that in the implied rate cuts within the futures was suggesting that the pace of rate cuts was relatively rapid and consistent. And so the market has certainly repriced that, and we've seen a flattening in expectations of future interest rates for the US. Parallel to that, we've seen a strengthening of the dollar as the market has interpreted both the rate implications there and the relative growth implications. And just as you pointed out, that then has the flow implications in terms of where does the money go. If we look at how global markets have performed since 2009, it has been an extraordinary period for the US, which has seen US leadership from global equity performance. There's not many markets that have been able to keep up, India being one of the very few exceptions from an Asian perspective. And within the US performance construct, it's really been about technology. So it's, in many respects, we see this cycle as having many sort of similarities to the 2000 cycle, where we see global performance coalescing and concentrating into the US market, and in particular technology driving that performance. That doesn't mean that emerging markets can't have a period of performance to follow. In fact, I'm very optimistic on the long-term outlook for emerging markets. But this change in the political dynamic, where we've gone from significant uncertainty, people not knowing what would happen to the US, to clarity, and not just clarity of leadership, but clarity of policy, then you're getting this renewed strength in the US market right now.
Got it. Shaun, one more question, and correct me if I'm wrong, of course, but the period that accompanied that very strong strength in the US markets in the past, and select markets like India maybe doing well, was also a period wherein European markets maybe did a lot better than what the perception about what Europe would do over the next 3, 4, 5 years is. So therefore, if there is a finite pool of money, but going into US, but then non-US taking exposure elsewhere in the world, would the scene be different from what it was in the past, wherein the money that would have gone into maybe European markets otherwise might find its way into other growth areas? Could that happen?
Yes, certainly. So investors from a geographic perspective where there's large liquidity have three core decisions. They've got the US market, they've got Europe, and they've got Asia, where there's large liquid markets with a significant scale of public investment opportunity, which enables flow decisions where they can move quickly between markets to deploy against global benchmarks. Within that construct, Europe's gone from serious European challenges coming out of the global financial crisis to clear addressing of that and recapturing the market's confidence, but then struggling to keep up with the dynamism and growth that's happened in the US, where we've seen Asia bifurcating between what's happened in India, and even there were periods where Japan was performing, and the deceleration in China. So we've seen quite a choppy rotation between markets. The consistent trends are really only been the US and India, where they've been pretty much trending growth markets that the market hasn't really questioned throughout the course of this cycle.
And I see that your colleagues have changed the India view ever so slightly, or maybe you reverted back to the China view, and thereby the India view gets changed as well. Can I ask you a bit about China individually, your own view? Because almost every single large believed to be bazooka from China has turned out, for lack of a better word, like a water pistol, or maybe slightly more than that. So if China is not quite able to give the stimulus that the market believes China would give, would that reduce the attractiveness of China, if not already, because we've seen the Chinese markets also come off in the last 30 to 45 days. So what happens there in that market?
Right. Right. So China's going through its own recalibration in that several months ago, we noticed that China had become too pessimistically perceived by international investors. The performance had obviously come off, and there was a real concern that the government would not provide support as it went through this transition, where China is effectively saying we cannot continue to rely on the property sector as one of the core engines when property prices had become both high and the amount of leverage in the system was high. And so they chose to address that. That was a policy choice made years ago, but the impact on the broader economy was really starting to bite over the last 12 months. The signal we got from the policymakers was one of saying we're seeking to manage risk and to avoid the worst possible points of downside from this sort of policy transition. This is reform that China should pursue. It's the right policy agenda in the long run. And so the market has become disappointed because over the last several years, through COVID and through some of the moves we've seen out of governments like the US, there's been some very aggressive government moves, which is ideologically not what the Chinese government is seeking to pursue. They're reluctant to take on aggressive levels of debt, and so the market has become short-term disappointed. My personal view is it's likely that China can make a relative low, where its relative performance compared to the rest of Asia can start to stabilise here, but in absolute terms the market's going to want to see some aggressive policy, and that's not likely because of the commitment towards reform.